you're not negative on stocks, but you do have a base case that at some point this year we're going to go down 20%.
You know, our take is we do expect that decline to happen when markets don't respond to good news.
Tom Lee believes the 20% drop could begin after March. Let's start with what Tom Lee actually believes is happening in the market at this moment.
Our bet would be markets are actually going to lift through the end of the month, that we're going to actually be positive for March and maybe hit 7,300.
So Tom Lee isn't calling for a crash tomorrow. He thinks markets could actually finish March in positive territory. That's the short-term setup. But the number he dropped, 7,300 on the S&P 500, that's where things get deeply interesting for Nvidia holders. Because what comes after 7,300 is warning number 2, and I'll get to that in a moment. First, warning number 1, and this one involves something that almost nobody is connecting to Nvidia. Oil. I know what you're thinking. What does oil have to do with Nvidia? More than you'd expect. And the connection is exactly what makes this warning so easy to miss.
Yeah, I mean, it's a very confusing time. I think it's very difficult if someone's trying to trade both the headlines or trade oil. Oil's $15 higher than it was last week, but the S&P's higher.
Oil jumped $15 in a single week. That's not a routine fluctuation. That's the kind of move that historically rattles markets, spikes inflation fears, and sends investors running away from high multiple growth stocks. And Nvidia, trading at one of the highest valuations in the entire market, is exactly the kind of stock that takes the hit when oil spikes hard. Here's the mechanism that most people don't think about. When oil goes up, it raises costs across the entire economy. Energy bills go up, manufacturing gets more expensive, and data centers, the very facilities that run Nvidia's chips around the clock, 24 hours a day, see their electricity costs climb significantly. When operating costs rise and profit margins get squeezed across the board, investors start questioning whether high-growth stocks are still worth their premium price tags. Tom Lee's take on higher oil is actually the warning itself. He says it's good for the United States stock market overall, and on a macro level he has a valid point. The United States is now a net oil exporter, so the country as a whole benefits when prices rise. But here's what he didn't say directly. That benefit flows straight to energy companies, not to technology, not to artificial intelligence, not to Nvidia. Warning number 1 for Nvidia holders is this. The oil spike that Tom Lee is calling broadly positive could quietly drain money away from artificial intelligence stocks and redirect it into energy. That rotation, if it picks up speed, puts real pressure on Nvidia before the wider market even shows visible signs of cracking, and it happens silently while most holders aren't paying attention. Now let's talk about warning number 2. This one is directly about timing, and it's built around a specific number. Remember the 7,300 level Tom Lee mentioned?
And maybe hit 7,300. Later in the year is when we think a bear market might show itself.
That's the ceiling Tom Lee is watching. He thinks the S&P 500 could rally all the way up to 7,300, and that's the exact moment he believes the bear market he's been predicting finally arrives. Think carefully about what that means for Nvidia holders. Nvidia has consistently been one of the most sensitive stocks to overall market sentiment. When the market surges, Nvidia tends to surge even harder. When the market falls, Nvidia tends to fall harder. That's just the nature of high growth, high volatility stocks. So if Tom Lee is right, if the market rips to 7,300 and then rolls over into a 20% decline, Nvidia holders who aren't paying attention could find themselves in the worst possible position, buying near the very top, right before the drop begins. That is the trap warning number 2 is pointing at. The rally feels good. It feels like confirmation that everything is fine, that the bull run continues, that artificial intelligence is unstoppable. But Tom Lee is telling you that the rally itself may be quietly setting the stage for something much more painful on the other side. And the timing is what makes this so urgent. Tom Lee isn't talking about some distant theoretical future. He's watching the market right now, in real time, as these signals are forming. Now let's pause for a second, because we're halfway through and I want to bring back the original question. Should Nvidia holders actually be worried? I'm going to answer that directly, but first there's a third warning, and this one cuts the deepest for anyone holding artificial intelligence stocks. Software.
Well, I think software has bottomed because we tend to price in the negative risks early. The IGV, which is the software ETF index, has lost 5 multiple points.
Tom Lee says software has bottomed, and his reasoning is solid. The sector got crushed, valuations compressed dramatically, and most of the speculative money already left. The pain already happened in software, investors already repriced it, and now it looks cheap. But here's warning number 3 for Nvidia holders, and this is the one that matters most. Nvidia has not gone through that same compression yet. Let me explain what that means in plain terms. A valuation multiple is essentially how much investors are willing to pay for every dollar of a company's future earnings. Software stocks used to trade at enormous multiples. Investors were paying a huge premium for future growth potential. Then reality set in. Growth slowed, the multiples collapsed, and now software trades at 16 times forward earnings, something Tom Lee calls reasonable, even attractive. Nvidia, still trading at a massive premium, still priced for perfection, still priced as if every single artificial intelligence trend plays out exactly the way the most optimistic bulls predict. No slowdowns, no competition, no execution risks. That means Nvidia hasn't had its own compression moment yet, and if the broader market starts rolling over, exactly as Tom Lee is predicting, the multiple compression that already hammered software could be the next stop for Nvidia. That is warning number 3. And it's the most dangerous one for long-term holders, because it's not just about a short-term price dip you can wait out. It's about a structural reset in how the entire market values artificial intelligence companies going forward. So what does Tom Lee actually think you should do with all of this?
When growth is scarce, people buy growth stocks. The U.S. stock market is a growth index, so it's coming out of the rest of the world back into the U.S. So I'd probably lean towards growth stocks outperform, which is not necessarily a broadening trade.
Becomes genuinely powerful. Even with all 3 warnings sitting on the table, even with a bear market potentially on the horizon, he's still leaning toward growth stocks. Not because the risks aren't real, but because when global growth slows down and uncertainty rises across the world, money concentrates into the markets and sectors that can still deliver real growth. And right now that means the United States, and within the United States, that means technology. Nvidia sits directly at the center of that thesis. It's a growth stock. It's a United States listed company. And it remains the single most critical enabler of artificial intelligence infrastructure anywhere in the world. So even as all 3 warnings apply that pressure, the underlying long-term case for Nvidia isn't dead. It's just far more complicated than most holders have been told. The smart move here isn't blind panic selling, and it isn't blindly holding without understanding the risks that are quietly building. It's knowing exactly what you own, exactly which warnings apply to your timeline, and exactly where your risk tolerance sits, before the market makes that decision for you.